Welcome to Module 9. So I'm sure the authors put their heads together and said, hey, I have a great idea. Why don't we make a single chapter and we'll put meals and entertainment and deferred comp and stock options in the same chapter? Yeah, that makes sense. Here we go. All right, let's start with employee versus independent contractor. So this is two ways by which you can compensate people for the personal services they provide. And this is not a choice, by the way. Though many employers treat it as such, it's technically not the case. So you simply have to follow the law. And there are three main categories of factors to consider whether you're going to treat someone as either an employer or an independent contractor when they provide services. The first is behavioral control, which is how the employees are directed and controlled. If they receive extensive instructions such as how, when, and where to work, what equipment to use. If they're under financial control, which is, do they have the right to direct or control the business part of the work? Did they make a significant investment? Are they being reimbursed for their expenses? Is there an opportunity for profit or loss? And lastly, the relationship of the parties. Are they receiving benefits like an employee would? Okay, so there is a large list of factors that you need to consider when you're trying to determine whether someone should be classified as an employee or as an independent contractor. And I'm not going to read all these because they're too extensive, but the list goes on and on and on, right? And it really does hinge off of those last three sort of classification of issues that we talked about. Okay, so that really brings us to the end of the list. So what's the big deal, right? If I'm an independent contractor, so what? If I'm an employee, so what? Well, it has a lot to do with self-employment taxes, as we now know, right? So do you pay self-employment, or is it employment taxes where you pick up half and your employer picks up half? Is their employer going to withhold taxes from the payments made to you, or do you have to make estimated payments? Will you receive benefits as a result of the work you're doing for your employer, or will there be no benefits? Employees don't get the QBI deduction, whereas if you're an independent contractor, you get the QBI deduction. And of course, there's, as we'll see, an array of business deductions that you can take when you're self-employed, but those are not available to you any longer as an employee because they eliminated the miscellaneous unreimbursed business expenses from the itemized deduction list starting in 2018.
Enough is enough! I have had it with these
unreimbursed employee business expense deduction.
Everybody strap in!
So classification matters. So Hardy has a choice, which by the way he doesn't really. But let's assume that we'll pretend he has a choice. He can either pay $40,000 to someone as an employee or a contractor. And to simplify this situation, we're going to ignore the value of benefits. We're going to say, look, there are no benefits, so don't worry about the value of those. So if Hardy's employed, then the gross income he would receive is $40,000. He'd pay taxable income of $40,000 on his $40,000. His taxes would be $47.40, and of course the employee share of Social Security would be withheld from his pay. So after tax, he'd end up with $32,200 in his pocket. If he's self-employed, first he gets a deduction for half of his self-employment taxes. He'd also get the QBI deduction, which would be on the amount of his gross income less the one half of self-employment taxes. That yields taxable income of $29,700. He pays income taxes on that amount, and then of course he pays all of the self-employment taxes. But you can see that the after-tax difference, although if you only made $30,000, that $1,300, $1,200 is probably going to make a pretty big difference to you. But the difference is about $1,200. If instead we're paying someone $140,000, let's see what that difference would look like. So now gross income's $140,000. The income taxes are up to almost $28,000. The employee's portion of Social Security is almost $10,000. Reminding ourselves that that's capped at 128.4 because we're presuming this is in 2018. The Social Security portion, at least, is. The Medicare isn't. So after tax, Hardy ends up with 102,119. If he's self-employed, you can see the gap is shrinking maybe a little bit. We're down to maybe $1,000, $1,100 instead. So you can see that the difference between employed and self-employed from the perspective of the employee doesn't seem to make a huge difference either way. So if we distill this analysis down, what we'd realize is that the real difference, the real monetary difference, comes from the benefits, right? So self-employed receives no benefits because you're an independent contractor, whereas the employed individual receives benefits. Okay, so other differences. We talked about business expenses being deductible. Well, if you're an independent contractor, you don't have commuting costs, so you could deduct your mileage. You can have a home office, and you can deduct any other costs attributable to the business. These are simply not deductible by an employee any longer. And of course, benefits such as healthcare, retirement, and any others that are offered by the employer are generally not offered to an independent contractor. Okay, so one last thing, and this is truly worthy of consideration because you can see that it sometimes makes a big difference. So let's say you're in the role of hiring Hardy, and you're trying to determine what to pay him. And you've decided that you're going to pay him $40,000 if you're going to treat him as an independent contractor. But if you treat him as an employee and the only benefit you provide is employment, his share of employment taxes, what offer do you make to Hardy as an employee? Do you offer $40,000, or instead do you say, well, let's see, you're not really going to you're not going to cost me $40,000. You're going to cost me more than $30,000. And what the research shows is that employers do recognize that difference. And they say, well, look, as an employee, you cost me more. So the net compensation package I'm going to pay you is less than if I were paying you as an independent contractor. Or put another way, independent contractors tend to make more than employees because they're not benefits burdened. The reality is research shows that the burden of both shares of employment taxes is borne by the employee. So what that means is the employer does in fact make an offer of lower income to the employee because they know they're going to have to pay that 1/2 of employment taxes. So here's what that analysis looks like, right? So if you're self-employed, I'm going to offer you $40,000. The net after-tax cost of that to me as the employer is $30,970. So in order to match that, I'm going to also offer you less if you're employed. Because I have to pick up the share of that cost, I'm only going to offer you $37,500. And as a result, the after-tax cost to me is about the same. Okay. So let's talk about deductions now for a second. So business expenses are deductible, whereas personal expenses are non-deductible. And we've hashed this out before. I usually draw a line on the board, and on one side I put personal, and on the other side I put business. And you can see that we've discussed this in the context of, look, everyone wants business expenses, no one wants personal expenses. So if Sally reads the Wall Street Journal every day, and let's say the Wall Street Journal costs $100 a year. Well, if it's personal, her after-tax cost is in fact $100 because she gets no deduction for that cost. But if it's business, and we assume she's in the 28% tax bracket, the after-tax cost of that subscription to the Journal is only $72 because she gets to deduct the cost and therefore lowers her tax liability. As a result, Sally's going to get the Journal sent to her office, or at least somehow try to claim that that is in fact a business expense and not a personal expense. So under this notion, taxpayers are going to try to classify all their expenses as business or for the production of income so they can deduct those costs. And the code's job, Congress's job, has been to try to find a way to stem our ability to do that? How do they stop us from shifting the character of personal expenses to business expenses? And they do that in various ways, and sometimes it's through complex rules, and other times it's through simple denial. So this is an area that saw some action in the Tax Cuts and Jobs Act. So you can expect differences. And one of the problems that I really have with this chapter is it goes into extensive detail about what the 2017 rules were. So whoever it was that authored this chapter was super lazy and just decided to continue to beef this chapter up with talk about old tax law that doesn't apply anymore. Now, there is some chance that some of this comes back after 2025, but that's so far away, we'll just have to wait and see. Okay, so mixed motive expenses are one of these issues where typically the code takes strict measures to try to prevent this. So let's talk about uniforms, right? So uniforms would ordinarily be a deductible expense if you use that uniform for business, but they are not deductible if you can adapt that uniform to ordinary clothing. So Felicia's a newscaster, and of course, as a result, she's required to wear fashionable suits for her on-camera appearances. Now, normally Felicia dresses a bit like a bum, right? She's just sporting her yoga pants and t-shirts. So her perspective is, well, wait a second, I only have to buy these fashionable suits when I'm on camera. As a result, I should be able to deduct those costs. However, if the suits can be used ordinarily, right? So if someone else could use that suit and consider it personal attire, then it is not deductible, and it's not relevant whether Felicia does wear them ordinarily or not. So whereas Officer Friendly is required to purchase his own police uniform. So unless you're in the Village People, a police uniform is not ordinary attire. Therefore, it's not adaptable, and Officer Friendly is able to deduct the cost of his uniform. Now, unfortunately, these rules have changed as well. Officer Friendly normally would have deducted that as a unreimbursed employee business expense.
Enough is enough! I have had it with these
Unreimbursed employee business expense deduction.
Everybody strap in!
Because typically police officers are not self-employed. As a result, he's not going to be able to deduct those costs. Okay, so another simple denial. No deduction is allowed for any item, for any activity of a type that is generally considered to be entertainment, amusement, or recreation. What this means is that entertainment expenses are non-deductible, even if they are directly or related to or associated with business activity. So there are a few exceptions to these entertainment rules. So food and beverage furnished at the taxpayer's business premises primarily for the taxpayer's employees remains deductible. The expense other than club dues of providing recreational, social, or similar activities primarily for the benefit of the taxpayer's employees, as long as it's not only highly compensated employees, remains deductible. Goods, services, and the use of a facility, if it's treated as compensation by the employee, is still deductible. Expenses connected with directors' meetings are deductible. The cost of providing entertainment or recreational facilities to the general public, or if in fact your activity is the provision of entertainment goods or services, all in those cases, all of the costs in fact remain deductible. No deduction is allowed for food and beverage unless the expense isn't extravagant, the taxpayer or one of the taxpayer's employees is present, that the expenditure is directly related to the active conduct of a taxpayer's business, or for an activity directly preceding or following a bona fide business discussion. And in the case of food or beverages provided during or at an entertainment activity, that food and beverage must be purchased separately from the entertainment. So recall, entertainment, non-deductible, food and beverage, deductible, so it needs to be separately invoiced. Okay, so it means directly related to the taxpayer's business means where it's involved in an active discussion aimed at obtaining immediate revenue, or it occurred in a clear business setting, for example, your office, or it was reported as compensation for services performed by an individual other than an employee. Associated with the active conduct of a taxpayer's trade or business, if there's a clear business purpose for the expenditure, such as to get new business or to encourage the continuation of existing business relationships. So obviously taking a client out to lunch and having a business discussion at that lunch qualifies that meal for deduction. Typically, only 50% of the meal is deducted. So remember, the way the IRS dealt, or the way Congress dealt with entertainment, is they simply said non-deductible. The way they deal with it with meals, where there's obviously a personal attribution that you could give to every meal, is that they only let you deduct 50% of the cost. And in certain industries, you can actually deduct different percentages, some 60, some 80, but that's a fairly narrow rule. So let's say you drive to meet a client, you have dinner with them where substantial business is discussed, and then you attend a sporting event and you drive home. In this case, the meal would be 50% deductible, but the sporting event, which is entertainment, is totally non-deductible. Let's say you drive to meet a client, you attend a sporting event where substantial business is discussed, and then you drive home. The sporting event is non-deductible entertainment, even if you had a substantial business discussion there. All right, so taxpayer A invites B, a business contact, to a baseball game. A purchases tickets for A and B to attend the game, and while at the game, A buys hot dogs and drinks for A and B. The baseball game is entertainment, therefore the cost of the tickets is not deductible. However, the cost of the hot dogs and the drinks, which are purchased separately, is not an entertainment expense, and therefore A could deduct 50% of that meal's cost. Taxpayer C invites D, a business contact, to a basketball game. C purchases tickets for C and D to attend a game in the luxury suite, where they have access to food and beverages. The cost of the tickets, as stated on the invoice, includes the food and beverages. As a result, none of this is deductible. So obviously it would have been in C's best interest to have whatever cost of the luxury suite that's separately, or whatever cost associated with the food and beverage in that luxury suite needs to be separately invoiced. So at least 50% of that cost could be deducted. So there are a handful of meals that aren't subject to the 50% limit. De minimis food, such as soda, coffee, donuts, or bagels for employees. And it means the cost must be minor and hard to track. So, for example, you can provide coffee for your employees, but you can't provide them gift cards to go to Dunkin' Donuts and buy coffee. Employee parties, as long as they're for the benefit of basically all of your employees, not just highly compensated, those are not subject to the 50% limit. Items provided to the public, such as samples and giveaways, and meals on employee premises. So if you provide meals on the employee premises and they're for the employer's convenience, those used to be 100% deductible. Starting in 2018, now we're down to 50%, noting that in 2026, those become completely non-deductible. Okay, another mixed motive area is travel and transportation. So travel and transportation for business purposes is deductible. This does not include commuting cost. Transportation is considered local transportation costs, whereas travel represents the cost of traveling away from home. And that's important because we treat them differently. Okay, let's start with transportation. So transportation is the so-called local travel expenses and would typically include things, maybe air travel, probably not, train, bus, cab fares, and more likely the cost of operating an automobile. So if you're self-employed and you work at 2 or more places each day, you can deduct the cost of getting from one to the other. This does not include the cost of commuting. Mileage is 54.5 cents a mile in 2018. It's now up to 58 cents in 2019. So let's say Mr. Hand drives 14 miles from his house to his office in Ridgemont. And at noon, he drives 11 miles from Ridgemont to Lincoln to attend a business workshop. And then at the end of the day, he drives from Lincoln to his home, which is a 19-mile drive. So from his home to Ridgemont, that is a non-deductible commuting cost. So you can see that in the circular chart. He's going from his home to his regular or main job. That cost is never deductible. Then he goes from his regular or main job to a temporary work location, right? So that's when he goes to Lincoln for the business conference. That's deductible. And then since his main job is in Lincoln, he can then deduct the cost from Lincoln to home since his main job is in Ridgemont. Okay. So you can, we've mentioned the standard deduction for mileage. This is in lieu of deducting your actual costs, so you have a choice. You can deduct the standard mileage rate or your actual costs. So your actual costs are your operating and fixed costs, including depreciation, maintenance, repairs, tires, gasoline, oil, insurance, and registration fees. And more recently, the IRS decided that car washes are also part of the normal operating costs of an automobile. Deductions for parking fees and tolls, those remain available whether you use the standard mileage rate or the actual. Standard mileage is not permitted if you have a fleet of 5 or more vehicles. So if you have a fairly large fleet of salespersons, for example, you're not going to be able to use the standard mileage. You're going to have to use the actual mileage rate. So generally you can use whichever is higher, except once you use the standard rate, you're generally stuck with the standard rate because they apply a penalty for depreciation for switching. You can switch from actual to standard if you've not taken any depreciation in prior years, but that's pretty unlikely. So as a result, switching tends to be very uncommon. So it's kind of once you start with a particular system, you tend to stay with that system for the life of that vehicle. All right, so a couple other weird things. So Stacy works in public accounting in New York City. And she typically commutes on the subway. So, of course, her subway pass would not be deductible because that's her commuting costs. However, during busy season, she often works until after midnight. And it's considered reasonable for her to take something besides the subway after midnight because that might be considered unsafe. As a result, Stacy can deduct the cost of her taxi home after hours, largely because it's considered unsafe, right? So there's kind of this reasonable standard of when commuting becomes unsafe. Okay. Now let's talk about travel. So again, travel relates to being away from home. So ordinary necessary expenses incurred by self-employed taxpayers while traveling away from home in the pursuit of a trade or business are deductible. So if they're for an employee, they're deductible by the employer, but not by the employee, even if they're not reimbursed by the employee. Well, they're not deductible by the employer if they're not reimbursed.
Enough is enough! I have had it with these
Unreimbursed employee business expense deduction.
Everybody strap in!
But when they're not reimbursed, the employee cannot deduct them because they got rid of that deduction category, which we've previously mentioned. So a taxpayer's home for travel expense deduction purposes is his or her tax home, which is generally the taxpayer's principal place of business, employment station, post of duty, and that's irrespective of where his or her family lives. So when an individual has no place of business or continually changes work locations, the taxpayer's regular residence is their tax home. If they have no regular place of abode, then they have no home and simply cannot deduct travel expenses. So that's the traveling salesperson who has no home. Tax home of a taxpayer who regularly works at 2 or more locations in the same general area is determined by taking into account the time spent, the business activity, and the financial return, income being the most significant factor amongst those 3. Okay, so when we think about travel away from home, we typically think about airfare, but that could be other forms. You could take a train or a bus. And the rules are different whether that travel is domestic versus international travel. So if it's domestic travel, if the trip is primarily for business, then 100% of the travel cost is deductible. If it's not primarily for business, then 0% is deductible. International travel, if it's primarily personal, then 0 is deductible. But even if it's primarily for business, then you must prorate the cost based on the percent business versus the percent personal of that trip. There is a special exception for international travel. If the travel is for 1 week or less than 25% of the time is spent on non-business activity, then you are not required to prorate that travel cost. The lodging, meals, and incidentals, if they are related to business, they are deductible. Meals, of course, at 50%. Otherwise, they are not deductible. So this often occurs for employers to employees through either an accountable versus a non-accountable plan. So Felicity travels for work. She's required to submit expense substantiation for all her costs. That's generally thought of to be an accountable plan. Lori travels for work, and she's simply reimbursed $100 per day, and it doesn't matter what she does. That is a non-accountable plan. So Felicity, because she's in an accountable plan, she's not required to include her reimbursed travel costs in her gross income. And as a result, she also doesn't deduct them. Her employer will deduct those costs. Lori, on the other hand, is required to include those reimbursements in her income. But currently, she is not able to deduct these costs because unreimbursed employee expenses are gone. So obviously, Lori should ask her employer to switch her to an accountable plan. Okay, so moving expenses are something we covered on the income side. We're not going to beat this up again. So thank you, next. So there are a series of educational benefits that are available to taxpayers. And unfortunately, this area of the tax code is simply a mess. And it's largely a mess because there are way too many provisions that trip over each other. They have differing definitions of what qualified higher education expenses are. And so typically taxpayers get really confused in this area. So let's talk about the 4 AGI educational benefits. So an employer can take a deduction for business-related education expenses, such as training. So if you go to work at a CPA firm and they send you away for training, that cost is deductible. It's also deductible if you're self-employed. For employees, however, it's probably not deductible. Sometimes the cost is included in taxable income, and sometimes it's not. The qualified tuition deduction was a deduction that was a personal deduction, meaning it didn't have to be borne by a business or business related, but it expired in 2017. Student loan interest is an educational benefit for taxpayers. So when you start paying your student loan interest back, there is a provision that allows you to deduct some of that cost. We discussed that in itemized deductions. From AGI deductions included the miscellaneous itemized deduction. That's gone, so we're not even going to worry about that. And then there are some tax credits, and when we get to the credit chapter, which I think is 13, we'll talk about those, might be 14, such as the American Opportunities Credit and the Lifetime Learning Credit. There's also exclusions from gross income, things like education savings plans, which is Coverdell and Section 529 plans. Contributions aren't deductible, but these create a lockbox scenario where the earnings are not taxable, and as long as you use the distributions for educational purposes, it's not taxable. Scholarships are excluded from gross income and aren't taxable, and there's employee education assistance programs that create non-taxable income as well. So we're going to talk about a few of these in this chapter. So one is the business deduction, right? So you can take a business deduction for educational costs if they're incurred to maintain or improve skills required by the individual in his or her employment, or they're incurred to meet a requirement imposed by law or by the employer for the retention of employment. Okay, but these are not deductible. Even if those prior to are met, they're not deductible if the education is required to meet minimum education requirements for qualification into the employment, or that education qualifies the taxpayer for a new trade or business. So Jane is a CPA, and in order to maintain her license, Jane has to receive 40 hours per year of continuing professional education. So if Jane is self-employed, she may deduct that cost because, of course, it maintains or improves the skills that are required for her as part of her employment. If Jane is an employee and her employer pays for the CPE, then the employer would deduct the cost, and Jane is not required to include any of that cost in her income. If Jane is an employee and her employer does not pay for that CPE, then unfortunately, under the current regime, Jane is unable to deduct those costs.
Enough is enough! I have had it with these
Unreimbursed employee business expense deduction.
Everybody strap in!
So Jane is a CPA. She wishes to improve her skills as a tax advisor by also getting a law degree. So in order to do that, first she's got to get a Juris Doctorate, a JD, and then an LLM, which is a tax specialization. So I don't think there's any question that this would maintain or improve the skills required by Jane as a CPA. I mean, if she goes ahead and gets a law degree, she's probably likely to be a better tax advisor. However, this cannot be met. This is not deductible because this also allows Jane to enter into a new profession, right? It qualifies her for a new job as a lawyer. As a result, if Jane were self-employed, the cost is not deductible as a business expense. If Jane is an employee and her employer pays for the law degree, then Jane will be required to include the reimbursement as income, and the employer simply deducts it as compensation. Okay, so Jane is an undergrad student at SDSU, and she's attempting to get her 150 units in order to be a CPA in California. Because this will meet the minimum requirements for the job, Jane may not deduct the cost of her undergraduate degree. But what if Jane were already a bookkeeper or an unenrolled tax preparer? Well, now things start to get a little trickier. So what if Jane were already an accountant and simply wanted to be a better one? So the issue is there were some court cases that were starting to allow these deductions. And more aggressive taxpayers will continue to take positions that they think make this cost deductible. But it's a tough road to hoe, and there are a number of court cases. So only the most aggressive taxpayers would continue to take a position like that. Okay. Because of education of expenses, this is what I just said. We continue to try to push on that. Okay, recall that the employer can deduct the cost whether it's qualified or not, right? So whether it was education, training cost, or compensation, the employer really doesn't care, right? Because they get to deduct it. So really the only difference is whether it's included in the student's income. So if that training is required by the employer, it's both deductible by the employer and excluded from that employee's gross income. So if part of an education assistance plan set up by the employer, then the employee can exclude up to $5,250 a year. Of course, the employee still deducts this. This is much less restrictive in terms of educational purposes. So it's not really required that it meet all those standards we met before. You can set this up for a self-employed individual, but note that if you are a 5% or greater owner, you may not take the deduction, meaning you can't be part of the educational assistance plan. So since most self-employed individuals are, of course, 100% owners or large percent owners, they generally cannot benefit from these. But this is more of a benefit that you can provide to certain employees. Okay. Another weird deduction is the office and home, right? So remember, these are all deductions that are on that slippery slope. Is it business or is it personal? And we've dealt with the allocation limitation issue, right? So we know that I have to allocate a certain amount of cost to the home office, and the limit is the amount of income generated by the business using the home office. So how is it that you can get an office and home deduction at all? So the general rule is that no part of a taxpayer's dwelling can be deducted as a business expense. So the general rule says it's all personal, none of it's deductible, but we're going to allow some exceptions. If the office is used regularly and exclusively as the principal place of business for a trade or business, then you can treat it as an office and home. If it's used regularly and exclusively to meet with clients or customers in the normal course of business, then you can deduct it. If the office is located in a separate structure and used regularly and exclusively in connection with the taxpayer's trade or business, or if the office is used regularly for the storage of business inventory and the taxpayer's home is the sole place of business, then you can deduct the cost. And notice for this fourth one that exclusivity is not required. So if you store inventory in your basement, I know basements aren't real big in California, but if you stored inventory in your basement, but you also use that as your family room, that would be okay as long as the home is the exclusive place of business, meaning there's no other office. Looks like I'm supposed to meet with Adam here at 10 a.m. Good for Adam. All right, this of course doesn't apply to employees because the rules were made so much stricter for employees. The whole unreimbursed employee business expenses. Oh, I'm getting tired of repeating that line.
Enough is enough! I have had it with these
Unreimbursed employee business expense deduction.
Everybody strap in!
And you're getting tired of hearing it. Switching gears entirely, let's talk about deferred compensation because that matches so wonderfully with meals and entertainment. There are two principal schemes for deferred compensation. Think of it as you're either deferring income to save for your retirement, or you're deferring income because you have enough of income currently and you just want to pay a lower tax, or you just want to defer paying the tax. And sometimes these two actually overlap, right? Just because you have enough currently doesn't mean you also don't want to save for retirement. Okay, and let's start with the premise that it is in the best interest of the government to get people to save for retirement because, like healthcare and like some of these other social programs, who pays for it if we don't save for retirement? Well, typically the government does, right? And we have a social safety network called Social Security and Medicare that are there for just that reason. So to the extent we save for our retirement, it's less likely we're going to be leaning on government transfers to get along. So let's classify these deferred compensation plans in three ways. First, we'll talk about big company plans. We'll talk about small company plans, and we'll talk about individual plans. And even though I've made up these classifications, they're making them, of course, imaginary, they are also not mutually exclusive. So a small company can use a plan that a big company uses. Some big companies are not eligible to use small company plans. And even individual things like IRAs, you find now you can have an IRA through your employer as well. So there's tons of overlap between these areas. So let's start with big company, right? So this is when you go to work at Qualcomm, for example. So qualification for a qualified plan hinges on the proper structure, there being no discrimination in favor of highly compensated individuals, and there being vesting requirements. So again, think of this like being an irrevocable trust or a lockbox. So the idea is you put the money in, and as long as you leave it in there and you don't pull it out for things other than its intended purpose, that it just gets to grow tax-free, and it's only taxed when it comes out. So big company plans are, of course, established by employers for their employees, and they come with all sorts of names: pension, profit sharing, money purchase plans, things like this. So in the instance of a qualified plan, what makes them so valuable is that the employer takes a current deduction for contributions. Okay, so that's as if the compensation's not deferred, right? Because remember, a retirement plan is really just a deferred income plan, a deferred compensation plan. So the employer goes ahead and takes the deduction. Well, they want that anyway, so they'd be fine. They could care less. The big difference is the employee gets to defer recognition of the income on those contributions. And that's true typically of their own contributions and their employer's contributions. So this is a way to receive compensation and not be taxed so long as you put it in a lockbox. So retirement is generally defined as 59 and a half years old. So most of the qualified plan lockboxes say, well, look, any distribution after 59 and a half is considered a retirement distribution. However, anything prior to that, you're breaking the rules of the lockbox. And so not only will you pay tax, which you would have to do anyway, but we're also going to penalize you. And the typical penalty is a 10% additional tax on top of what you would pay otherwise. Okay, so let's talk about the types of qualified plans, and we'll talk about the one that relates primarily to old school, right? Now, I happen to be an employee of the state of California, so I am also in what's called a defined benefit plan. And if you've been through intermediate to accounting, you should have done pension accounting, and you'd know that this is a plan that defines the benefit that an employee will receive upon reaching retirement. So it's defined based on the benefit that it's going to pay. So typically you'd see something like 80% of the average salary for the highest 2 years that you worked there. And that's the amount that that plan is going to pay to you as a benefit. So defined benefit plans are an actuary's dream, because there's all sorts of things we don't know. So let's say you go to work for the state of California and it's your very first year. You plan on working there for 35 years, and who knows what's going to happen, right? So what's your highest salary going to be? Well, we don't really know. When will you retire? Well, when you're 21, you don't really know that. How long are you going to live after you retire? Well, we certainly don't know that. And what will the investments that you're going to put the money in, like what are the lockbox investments going to return? We don't know any of these. However, based on all that information, we need to try to determine how much should be contributed today. So what happens is the actuaries crank through all these estimates and they figure out, okay, here's how much you should contribute to that person's defined benefit plan today so that the plan is what's called funded. Now, what happened is in the 70s and 80s, life expectancies increased dramatically, right? So your grandfather's plan with the union, where he worked for SDG&E, said, look, we'll give you 100% of your wages until the day you die, because everyone thought you were going to die at 67. And then people lived to 77. And then they started living to 87. And what happened is, as a result, all these plans were underfunded. And it's not the actuary's fault per se. They just didn't realize people were going to live 20 years longer than everyone thought. So what happened is this led to a rash of bankrupt pensions in the 80s. And at the same time, because these liabilities started appearing, the folks down at FASB said, hey, maybe we ought to start measuring that liability differently than the amount we're supposed to fund that year. Because up to that point, that was the liability you put on your books. Well, what amount do I owe for this year? That's my liability. And they came up with this pension accounting scheme. Those two things jointly created the demise of the defined benefit pension plan. Now, that's not to say they aren't around. You usually see them in government or kind of old school industries like auto and steel and this or coal mining, that sort of thing. There is a limitation on the amount of benefit that you can be paid. Now, this is different than most of the other plans where there's a limit on the amount of the contribution. So for defined benefit plans, the limit on the benefit is the lesser of $220,000, at least in 2018, or 100% of the employee's average compensation for the 3 highest years of employment. Defined contribution is pretty much any kind of qualified plan that isn't a defined benefit plan. So let's go into the Wayback Machine and talk about defined contribution plans, because in the old days, we primarily had defined benefit plans. So the first ones were profit sharing plans. And this was a pretty good idea. It said, hey, employees, if we make a profit, we'll share some of the portions of that profit with you through a retirement plan. And the idea would be, hey, that should provide incentive to employees because they should be interested in generating profits as well. And so the employers set these up, but what happened is people weren't satisfied with that. They wanted the money today. And slowly, as defined benefit plans went away, they were largely replaced with what's called the 401k plan. And 401k plans are probably undoubtedly the most popular of the defined contribution plans in the U.S. today. So step one was employees should save for their retirement. So, hey, employees, join the 401k. So a bunch of employers are like, yeah, no thanks, I'd rather have the money now. However, of course, more affluent employees would continue to save for their retirement, hearkening back to that original thing where I said there's two reasons to save for your retirement. One is to save for your retirement, and the other is because you can defer compensation because you have enough already. Well, people who have enough already to live, they're more than happy to defer some of their compensation into a 401k plan. So what happened is it failed the non-discrimination tests. So these plans would fail the non-discrimination test. So as a result, employers had to come up with a new strategy. That new strategy is, hey, how about if you contribute money, we'll match your contributions up to some percent. So this did, in fact, create more interest, but clearly still not enough. So the latest data shows that about 21% of Americans have saved nothing for retirement, not a single dollar. And another 10% have $5,000 or less for their retirement. So employers got into the same problem. We're failing non-discrimination tests, and people are not adequately saving for retirement. So the government basically said, you know what, we'll go with an opt-in program or an opt-out program instead of an opt-in program. So basically, many employers now automatically enroll you in their retirement savings on the very first day of work unless you opt out. And the idea is that's hopefully driving more and more people to save for retirement. Okay, defined contribution plans don't have a benefit maximum. Instead, they have a contribution maximum. And the maximum contribution is the lesser of $55,000, at least that's the 2018 cap, or 25% of compensation. Limited to $275,000 of compensation. Now, strangely, if I take 25% of $275,000, that amount is actually more than $55,000. So let me see if I can explain this to you. So Thora has wages of $350,000. Her maximum contribution is the lesser of $55,000 or 25% times 275 or $68,750. So of course it's always going to be $55,000. So why even have that second number? Let me see if I can explain it to you. Because the math is strange for self-employed individuals because they take a deduction for the contribution. So let's say that a self-employed individual has $100,000 of income, and they say, okay, well, I can contribute up to 25% of that amount. So 25% times 100,000 is 75,000. You say, well, wait a second, then you don't have 100,000 of income, you only have 75,000 of income. Oh, right, 75,000 times 25% is 18,750. So I don't have 75,000 of income. Instead, I have 100,000 minus 18,750 or 81,250. Well, wait a second. 25% of 75,000 isn't 25% of 81,250. So 81,250 times 25% is 20,312. Wait a second, then 81,250 isn't the right number. It should be 100,000 minus 20,312 or 79,687.50. And you can keep iterating this over and over and over again. Eventually it converges to $20,000, or in this case 20%, which is the same as 0.25 divided by 1 plus 0.25. So if you took 275 and multiplied it by 20%, guess what you get? $55,000. Okay. So the 401k is an extremely popular type of defined contribution plan, and it's one in which an employee actually elects to defer a contribution into the plan. So basically, as an employee, you say, hey, I'd like to take 10% of my salary and defer it into the 401k plan. So I therefore get 10% less in wages every year. So Kim earns $70,000 of wages. She elects to defer 10% of her salary into the employer's 401k. As a result, Kim will be taxed on only $63,000. That's the $70,000 minus 10% of the $70,000. And that $7,000 will now start to earn return until she retires, and she won't pay tax on it until then. When that 401k distributes the money to Kim, she will pay the tax on both her contribution, the $7,000, and any of the earnings of the 401k at that time. And of course, if she takes it out before she turns the magic 59.5, she'll pay an extra 10% tax unless she qualifies for one of the handful of hardship exemptions that exist. So the max deferral that you can have in 2018, so the most you can have taken out of your salary and contributed to a 401k is $18,500. I believe it's up to $19,000 in 2019. Of course, the overall limit that we discussed of $55,000 also applies. And of course, you cannot defer what you do not earn, so the amount of your compensation also is a maximum, right? So if I only make $15,000 a year, I can't defer $18,000 because I only made $15,000. And the company, your employer, may match your contribution, so they can make a additional contribution on your behalf. And again, you do not include that in your income, but it is counted as part of the $55,000 limit, not of the $18,500 limit. So Helga earns $45,000 in 2018. She elects to defer 10% of her salary into the 401k, and her employer matches the first 4%. Well, the 10% is $4,500 plus the 4% that her employer is matching, or another $1,800. All that is contributed to her 401k. That's clearly well below both the $55,000 and the 25% limit and the $18,500 limit in 2018. Helga's taxable compensation for the year would be $45,000 minus $4,500, or $40,500. And if you recall, back when we did gross income, we said, hey, these can represent a difference between your Box 1 wages and your Box 3 Social Security wages. Because even though that $4,500 contribution is not subject to income tax, it is subject to Social Security tax in the year of the deferral. So Helga's 401k then goes on to earn $3,000 over time, and she retires and distributes the entire balance to herself in a taxable distribution, which you wouldn't ordinarily, but bear with me. So that means that her $4,500 is taxed, plus the $1,800 her employer gave her is taxed, plus the $3,000 of earnings that it made is taxed. It's all taxed when it is distributed. So deferral takes advantage of two lockbox elements. Number one, the contributions are not taxed until they're distributed. And number two, the earnings are not taxed until they're distributed. So to map this out, let's go work in Excel for a second. Okay. So what I'd like to do in this Excel spreadsheet is show you guys how the deferral of income can make such a huge difference in terms of a qualified plan versus some other type of saving. Okay, so let's say that we have a taxpayer in the 22% tax bracket, and every year they're going to contribute $10,000 to their 401k. Now I know $10,000 seems like a lot now, but if the employer's matching and some of these other things and your income starts to get up, it actually amounts to a pretty decent amount. And let's say that they expect a 5% return across a 20-year time horizon. And 5% isn't extraordinary over 20 years. Certainly historically, the stock market has done better than that. So you can see that if you put that money to work, but you pay tax on it first, right? So you get your wages, you take the income, you pay tax on it. That only leaves you $7,800 to invest. The annual return of 5% is taxed, right? Because it's not in a lockbox. So your after-tax return is only 3.9%. The future value, so that amount's going to grow to be about $230,000 in 20 years. What if instead you put it inside, for example, a 401k or some other form of qualified plan? Well, the same $10,000 now isn't taxed currently. Recall that we get it, but we don't pay tax on it now. So that means all $10,000 gets invested. It also means that the return that it generates isn't taxed. So you get all 5% of your return. And you can see that over 20 years, the difference is about $100,000, right? So the power of using these qualified plans for retirement is pretty valuable. Now, let's pretend we're affluent. So let's go up to 37%, and let's say we can manage $20,000 over the years, and let's do it for 35 years. Now you can see that the difference really becomes immense, right? So by boosting the amount of tax that you would have to pay and boosting the investment out in the number of years, you can see that return, and if we could draw a graph, we'd see the return in the later years just crushes the taxable return. So this is actually the power of qualified plans and the whole lockbox mentality, which is why it makes a ton of sense, of course, to save for your retirement. So let's do something a little more modest, shall we? Let's go back to 22, and let's say you only save $5,000 a year, but you do it for 35 years. Even then, you can see you nearly, not quite, I was going to say double, but 35 years is not that long of a window, you guys. If you start work when you're 21, that's 56, right? That's not that long. So considering most people retire when they're 65, you can see that if I just bump this up to 45, look at the difference. So again, this idea of using qualified plans, this is one of the reasons that they are so popular. Okay, let's head back to PowerPoint. Okay, welcome back. So with many of these plans, you can make an after-tax contribution. So what that means is you wouldn't get a deduction at the time of the contribution, or you wouldn't be able to exclude it from your income, but the earnings can remain deferred. Okay, so like a post-tax 401k contribution. Certainly you would want to max out your pre-tax contributions before you would consider after-tax contributions. In almost all situations. There actually can be situations where that's not true. All right, so from an employer's perspective, the contribution is just another form of compensation, right? So we talked about this a few slides ago when we said, hey, don't you think employers adjust the amount of pay to reflect the cost of things like employment taxes and benefits? And of course they do. So a contribution to a pension plan or a 401k plan is also something that's built into the after-tax cost of an employee. So we need to remember this. From the employer's perspective, it's not just the wages. It's the wages plus the health care plus the retirement plus any taxes that the employer has to pay. So Mickey makes $11.50 an hour, so let's call that $23,000 a year. If there's no benefits, then the after-tax cost is $19,560. But if, for example, we get benefits loaded, right? So we add healthcare at a meager $4,000, and I assure you, $4,000 is meager, and we give a 401k match of 4%, then you can see that suddenly Mickey's $11.50 an hour goes all the way to $14.88 per hour. So substantially higher, and of course the after-tax cost is also higher. So this is why employers should consider the cost that extends beyond just the wage that they pay their employees. All right, so what do you do if you work for an employer and they simply don't have retirement for you, right? Are you lost? Can you not save for retirement? And of course the answer is no. This is the birth of the individual retirement account. And there are two kinds of individual retirement accounts. There's the traditional IRA, and there's also the Roth IRA. The Roth is the newer, it's not that new any longer, but the newer of the two. And you can even contribute to these as late as the time at which you file your original tax return on April 15th. So that means you can prepare your entire tax situation, and you can say, you know what, I think I'd really be better off if I chucked in a $5,500 contribution to my IRA, and you can reflect that on last year's tax return as long as you make that contribution by April 15th. So clearly the government is trying to make allowances for folks to save for retirement to the extent humanly possible. Okay, so in a traditional IRA, you can contribute up to $5,500 per year, or your earned income if that is less. So for example, if you only make $4,000 a year, the maximum you can contribute is $4,000. If you're older than 50, you can make what's called a catch-up contribution. Basically, the idea is, look, if you're 50 or older, you're starting to run out of time to save for retirement. So we'll actually let you contribute a greater amount than those that are under the age of 50. Contributions can be tax deductible. And this depends on whether or not your employer provides a retirement plan for you. So if you flip back many modules ago to module 2, when we talked about the W-2, you would see that there are boxes on the W-2, and one of them is where you would check a box that says retirement plan. That means that that employee is retirement plan eligible. If that's the case, there are actually income limits that allow you whether or not you can deduct the contribution you make to an IRA. So the limit 63,000 single, 101,000 married filing jointly. Those are 2018 limits. They are adjusted every year. So what that means, if you're a single taxpayer that makes 70,000, then your contribution is going to be limited. If you're part of a plan. If you are a single taxpayer and you make $1 billion, but your employer does not have a retirement plan, then there's actually no limit. You can contribute up to $5,500 or $6,500 if you're 50 or older. So there are special rules if one spouse is plan eligible and one is not plan eligible. And of course, you must always have earned income. So, and in this case, distributions from a traditional IRA are taxed just like a 401k, just like ordinary income. So, which is a good time for me to bring up. I probably should have mentioned this earlier, right? So when your IRA or your 401k or whatever it is, when your lockbox account is investing, let's say that it generates both interest income and dividend income. And let's call it even qualified dividend income. It doesn't matter. All of it is taxed at ordinary income rates. So when you're thinking about what to invest your IRA in, if you have other portfolio savings, you want to think about things that would be taxed at the highest rate otherwise, because all of it's going to be taxed as ordinary income. So you want to maximize that with deference to what the tax rate is, because it's all going to be at the ordinary rate. So the idea of investing in high dividend yielding stocks as part of your qualified plan generally doesn't make a lot of sense, because it's all going to be taxed at ordinary rates anyway. Okay. The Roth IRA is something that's pretty unique because you can contribute up to the same $5,500. However, that is not deductible. You do not get a current deduction for a contribution to a Roth. However, the distributions out of that Roth are not taxed. Now, a lot of people say, oh, that's awesome. There's no tax on my Roth distribution. But remember, most of that money's after tax to begin with, right? So the $5,500 you put in, that's just your money. So really what you're enjoying is better than a traditional IRA where the money in the lockbox, as it earns money, it's deferred. No. This is exempt, right? So a qualified distribution from a Roth IRA is simply excluded from gross income. So all the earnings that would generate they all come out tax-free. So let's think about planning for a second, right? So let's say you're young and your tax rate is fairly low. So the current value of that deduction is lower to you, right? If you only pay 10% tax, then saving 10% for a $5,500 deduction, that's fine. But if you start a Roth IRA when you're 21 years old and you have some earned income, and it grows and grows and grows and grows and grows, and then you pull it out, and it's all tax-free, well, that can be a huge tax win. So what you find is that, first off, there are income limitations, right? So if your income exceeds a certain amount, you're not allowed to contribute to a Roth IRA. So if you make more than 120,000 single or 189,000 married filing joint, you actually cannot make contributions to a Roth. However, if your income is below that level, then you have to do a trade-off between, well, is it worth it to get the current deduction against my taxes today, or am I better off not taking the deduction, meaning paying taxes on the $5,500, but allowing that money to grow tax exempt for the rest of its life? So there are a few rules. Roth distributions also require you to be 59 and a half. You also have to have had the money at work for at least 5 years. Okay. So the last area we're going to cover, and we're really going to cover it for the most part a little bit superficially, are plans for self-employed individuals. So the problem is, over the last 3 decades, we have had so many different types of qualified plans for self-employed individuals that it's just a mess. So I've created a partial list here from Keogh's back in the 1970s, I think, to more commonly today a SEP IRA or a simple plan. You can see that there's just all sorts of plans. Now, not all of these are in place any longer. For example, you can't even start a new Keogh plan. The problem is retirement plans are intended to last 30, 35, 40, even 45 years. And so if the tax code made one available to someone back in 1979, there's some chance that individual hasn't even retired yet. And so as a result, you end up with these legacy plans that just linger, but don't really speak to anyone who would become active as a self-employed individual today. Okay, so what are the big ones that are currently in place? Well, big one is a SEP IRA. This is a simplified employee pension. So this means that this is good. It provides some flexibility to the self-employed individual. The contributions can change and can even be zero. The employer must cover all employees that meet requirements. So what that means is, with a simplified employee pension, if you decide to make a contribution for any employee, all employees have to also receive whatever that contribution is. Say it's 2% of your salary or something like that. We have the same maximum 25% of compensation or $55,000. And a SEP IRA, by default, simplified, is supposed to be easy to set up, and it is. So you can go to Vanguard or Fidelity or Schwab or a number of other large financial institutions as a self-employed individual and say, hey, I'd like to set up a SEP IRA, and they'll give you the one-page form, and you can basically do it in about 30 minutes. It takes no time at all, and you can start saving for yourself and any employees if you have any. So another one is called a simple plan. This is also for small employers. You have to have 100 or fewer employees. And you can set up a simple plan as either an IRA or a 401k. So remember, an IRA would think of it as the employee can self-direct into a number of different investment options, whereas a 401k typically has 4 or 5, maybe 6, maybe as many as 10 different categories that person can invest in. So you must match each employee's salary reduction contribution on a dollar-for-dollar basis up to 3%. So the cost of a simple is you don't have the flexibility you had with a SEP IRA, right, where contributions could change or you could contribute nothing. In a simple, you must match the employee's salary reduction on a dollar-for-dollar basis up to 3%. You can make non-elective contributions of 2% of the employee's compensation. However, if you choose to do that, you must make it for all eligible employees. So again, you can see we talked about this when we started the whole deferred compensation. We said, look, these qualified plans, they often lean heavily on non-discriminatory provisions that don't allow you to only favor highly compensated individuals. And this is a classic case with both of these, right? If you cover any employee, including yourself, you cover all employees. Or if you make non-elective contributions, then you have to make them for everyone. Okay, so there's also something called a Coverdell. A Coverdell was basically a Roth IRA, except for higher education. So it was called a Coverdell, I think it was called a Coverdell IRA in the old days. These are almost gone. You can still find them. It's not dead, but it's been replaced by other options. You can contribute up to $2,000 a year. It was non-deductible. There was an income limit, so if you made more than a certain amount of income, you couldn't make contributions to a Coverdell. But these are not widely used because Congress introduced the Section 529 plan. And the big difference between the 529 and the Coverdell was the higher contribution limits and no income limits. So they kind of unshackled the income limit from being able to make contributions, and the contribution limits are very high. They actually vary by state based on the highest tuition for the state in which you live, and so you can contribute, $50,000 to a 529 plan, whereas a Coverdell was limited to $2,000. So, as I like to say, the Coverdell was building a college savings plan for people that couldn't afford to save for college. That's basically what that was. So good if that's all you can get to, but not as good as a 529. So health savings accounts we've already talked about. I'm not going to beleaguer this again. So now we switch to non-qualified deferred comp, right? So we've discussed now repetitively what the advantages to a qualified deferred comp plan are, right? That's that whole lockbox mentality. So in some instances, you get a deduction or an exclusion for the amount you put in. In others, you don't get the exclusion, but in all of them, as long as you use that money for its intended purpose, it came out either deferred or exempt, one of those two. So non-qualified, as you can imagine, must be a situation where you do not benefit the same way you would from a qualified plan. So generally speaking, you do not have to include it in the income of the employee. However, the flip side is it is also not deductible to the employer. So this is generally aimed at people with adequate compensation otherwise, right? So this is the classic signing bonus non-qualified deferred comp, right? So if Tom Brady gets a signing bonus or a Super Bowl bonus, you can probably be pretty sure that that contract level, he doesn't really need the money. So part of it is, well, maybe I can defer paying on taxes on it till a future date, one. Or two, on top of that, maybe I'll be in a lower income bracket when I retire, and therefore I can pay less tax on it then. So money is often set aside, but must remain within the reach of the employer's creditors for this to qualify as non-qualified deferred comp. So the rules are quite permissive, right? You can do all sorts of things in terms of limitations and income limitations and contribution limitations, without getting too deep into it. However, the penalties are extremely severe if you mess that up, right? So non-qualified deferred comp is definitely for the experts only. And you should know that lots of executives will use non-qualified deferred comp. And the idea is the value of the deferral, right? It's all about time value of money, typically. Okay. So Colbert's a great employee, and the corporation wishes to reward him with shares of stock. So constructive receipt requires the fair market value of stock would be included in Colbert's income on the date of transfer. So that would mean that Colbert would have to pay taxes, but of course stock is not cash. So he's got to pay taxes, but he has no cash. Not to mention, once Colbert gets the shares, if he's going to sell them, he doesn't care any longer if the stock price goes up. So instead, maybe if Colbert is a great employee, the corporation wants to reward him, and it says, look, we're going to give you shares of stock in the future, right? So instead of getting them now, Colbert's going to get 1,000 shares of stock as long as he still works here 3 years from now. And during that time, he may not sell the shares that are set aside for him. And now it's clearly in Colbert's interest to have that stock price go up further, because that just means it's going to be worth more. So what happens is on the date those shares vest, right, which vest means they become within Colbert's power, that's when he's taxed and the corporation takes a deduction for the fair market value of that stock. So we typically call this restricted stock. So Colbert's granted 1,000 restricted shares when the fair market value is 2 a share. Let's call that, I don't know, the pre-IPO price. In 3 years, when the stock is vested, it's expected to be $100 per share. Let's call that the post-IPO price. So one of the things Colbert can do is he can make an election called an 83B election. And what happens is, rather than wait until those shares vest, he can include them at their current value in the year of the grant. So since it was $2 when they were granted, he could include $2,000 in his income. When you make an 83B election, when those shares vest, in theory at this $100,000, there's no income. None. Let me repeat that. None. He's already captured the fair market value of that property. Now, that's not to say that if he turns around and sells those shares, he won't recognize gain. He will. But what he's done is he's avoided $98,000 of ordinary income. So the basis of the shares is the amount included in compensation. That's $2,000. Again, when he sells it, he will recognize $98,000 of long-term capital gain. But I think we can all agree that long-term capital gain rates are generally preferential to ordinary rates. Okay, so this sounds like the ultimate deal, right? Make the 83B election every time. What happens, number one, if he leaves before the shares are vested? Well, nothing happens, right? He gets no deduction, even though now he doesn't get the shares. The second thing that could happen is when the fair market value is ridiculously low, like I said it here at $2, what if the stock goes down to $1 or $0 or 50 cents or 10 cents on the share? Now he will have included it at $2,000 when in fact the value, when he finally gets it, is $250. So now he's paid tax on phantom income. So you always have to be a little bit wary of 83B elections. In this pre-IPO, post-IPO format, that's usually more of a sure bet, right? But you can imagine that, what if instead that price were $80 and you were hoping it went to $120, right? Well, now it could go to $120, but it could equally go to $60. Well, now you're like, wow, do I really want to lock in my income using that 83B election or not? So you just have to make sure you understand the whipsaw effect that could get you. Okay, so another form of stock-based compensation is stock options. And a stock option is simply giving a right to an employee to purchase the company's stock at a price set at the grant date. So there are two kinds: incentive stock options, or ISOs. And this is one where the employee will recognize capital gain when the stock is sold, but the employer gets no deduction when those options vest. So what are the requirements to have ISOs? Well, first off, the option price has to be greater than or equal to the fair market value of the stock price at the grant. There has to be no more than 10 years before exercise. The option must be non-transferable, so you can't give it to your relatives, your kids, your friends, whatever. You cannot own more than 10% of the corporation, and you cannot receive more than $10,000 of value in any year. And a big restriction is that the employee must hold the incentive stock option for at least 2 years from the grant and at least 1 year from exercise. So ISOs are intended to be a longer term sort of compensation plan. So Colbert is granted 100 options to buy Nation Corp stock for $10 when the fair market value is $10 on January 1st of 2017. And those options are going to vest 100%, so all of them vest, all 100 options vest in 2 years. So on January 1st of 2019, 2 years later, his options vest when the fair market value is now 23. So if Colbert exercises the option and buys 100 shares for $10 when the price is 23, so let's think about that transaction for a second, because that's how stock options work. Colbert got to go out and buy something that's worth $23 for only $10, right? That's the value of the stock option discount. If these are ISOs, if they are incentive stock options, there is no taxation at the exercise. If Colbert then waits the year, which he's required to do under the ISO rules, and then sells them when the price is 30, then what happens is he recognizes a long-term capital gain of $20. So the cool part about ISOs is you don't escape taxation, But instead what happens is you get basis for the amount you actually paid, right? Because he is in for the $10. But then when you sell them, all of the income is treated as long-term capital gain income. There is never a deduction for the corporation that grants incentive stock options. You typically see ISOs only to executives. Most corporations do not issue ISOs to rank and file employees. Excuse me, I had to take a little drink. By the way, I'm drinking, it's past lunchtime, and I went to a place called the Crack Shack in downtown San Diego and had one of the most fantastic, delicious chicken sandwiches I've ever had. So big props out to the Crack Shack down in very close to Little Italy in San Diego. Okay, so how about non-qualified stock options? I'm thinking I should have received some stock options for my plug there for the Crack Shack. Non-qualified stock options, in this case, the employee recognizes income for the difference between the fair market value and the exercise price at grant, if any. Now, typically they are not offered at a discount. And then upon exercise, the fair market value minus the option price is income to the employee and a deduction to the employer. Okay, so let's just do an example. So here we are, Colbert is getting 100 options for $10 when the fair market value is 10 on January 1st, 2017. The options vest 100% in 2 years. Now, there's no such requirement that these vest 2 years or more for non-qualified stock options, but we're just keeping this, this example the same as the last one. So sure enough, they vest on 2 years later, and the fair market value is 23. So Colbert exercises the option and buys 100 shares for $10 when the price is 23. Because these are non-qualified, that means Colbert needs to recognize ordinary income of 13. That's the difference between the option price and the fair market value on the date of exercise. The corporation takes a symmetrical $13 deduction. So let's say Colbert then does not wait a year, because of course he's not required to do so, and turns around and sells those shares. Well, he gets basis for the amount he's included. That's the $10 he's paid plus the $13 of income he had to recognize. So his basis is 23. If he turns around and sells it for 23, then of course there's no gain or loss and no more taxes is due. But let's assume instead that he waits for a year and the price goes up to 30. Now he would recognize 30 minus his basis of 23, or $7 per share of long-term capital gain. Okay, so one last rule on ISOs. If ISOs are sold before 2 years of grant date or 1 year of exercise date, then you basically treat them like a non-qualified stock option. So that's called a disqualifying disposition. So a couple other issues associated with options. The first is when you have non-qualifieds, or ISOs for that matter, the employee must come up with the cash to buy the stock. Recall, Colbert needed $10 a share. So a lot of corporations will involve a broker, a stockbroker, who will allow employees to do what's known as a cashless exercise. So think of it as the broker loans Colbert the money and then sells the shares immediately and pays off the loan. So the thing is about this is that the employer doesn't really like the dilution of stock holdings and the public perception of insider selling, right? So really employers would love employees to hold the stock long term because of course that aligns the incentives of owners and management. So sometimes what they'll do is issue something called a stock appreciation right with the options, in which case the employee is eligible for a cash payment of the amount that the stock appreciated since the right was granted. And so that aligns, but it also provides some cash for the employee. And typically you see stock appreciation rights, or SARs, again, only with executives. So Colbert also gets 100 SARs. At grant, for a stock appreciation right, nothing happens. When they vest with the options, Colbert paid $13 per SAR because that's the price increase he receives. He doesn't pay. And now he's got the money to buy the shares and pay taxes. All right. So that brings us to the end of Chapter 9, the mixing bowl of business expenses and compensation. But we're not quite done. There's a couple things in Chapter 10 I want to cover. So only pages 10.6, 10.7, and 10.8. None of the rest of that chapter. because all I really want to talk about is a quick overview of Section 179 and bonus depreciation. And largely I want to cover the changes in the Tax Cuts and Jobs Act from 2017. So, because I guess for some of you, maybe you haven't covered this material either at all, or you certainly didn't cover it in your last tax course. So, let's recall, would we rather capitalize the cost of an asset and recover its cost over time, or deduct the cost immediately? And kind of under our general rules, we always think of, no, we want to accelerate deductions. We simply want to deduct the cost immediately. And the tax code includes two provisions that are designed to accelerate the recovery of what would otherwise be depreciable property, and that's Code Section 179 and bonus depreciation. So let's start with 179. Section 179 permits a business to immediately expense a certain amount of otherwise depreciable property placed in service during the year. So, three important elements. First, the property must qualify under 179. The amount must qualify under 179. And it must not create a loss. So we need to figure out what these three elements mean. So, for 179 to apply, it must be purchased tangible personal property for use in an active trade or business and placed in service this year. So that means it does not apply for the production of income. So if you own a little condo on the side and that's only reaches the level of production of income, then you may not use 179 on the tangible personal property you place in service with respect to that condo. So in 2018, or I shouldn't say it that way. So notice that it says personal property, not real property. However, there is a category in 2018 of qualified improvement property. So that's any improvement to the interior portion of a building that is non-residential real property if the improvement is placed in service after the date the building was first placed in service. So what this means is, hey, you can make improvements to a non-residential office building and go ahead and treat those as 179 property, even though it's not personal property. 2018 also added a number of other elements of what I would describe as real property. So roofs, heating, ventilation, and air conditioning property, fire protection and alarm systems, and security systems. Now these were all added, replacing what used to be known as qualified leasehold improvement property, qualified retail improvement property, and qualified restaurant property. These all used to be eligible for 179 as well. So what amount qualifies? So in 2018, you could take up to $1 million. So if I invested $1.2 million in a roof, then I could deduct $1 million of that $1.2 million. However, 179 is intended for quote-unquote smaller businesses. And what happens is it begins to phase out when your eligible 179 property is over $2.5 million. And both of those numbers are adjusted for inflation each year. So I'm not going to go into the details of that phase out because it would take too long, right? So we're not going to, well, I tell you what, we'll do this one. X Corporation places in service 1.24 million of 179 property. Since the property is less than $2.5 million, there's no phase out. They would deduct the full $100,000. What happens to the remaining $240,000? That would be depreciated under the normal maker's rules. Now, just to be clear, X Corporation could elect no 179. They could elect $1 of 179. They could elect $10 of 179. Basically, they can elect anywhere between $0 and $1 million of 179, and it could be on a single asset or a bundle of assets. Y Corp places in service 2.8 million of 179 property in 2018. So they are above the 2.5 million mark. Therefore, the phase out is in effect. Let's see how that phase out works. So the 2.8 is in excess of 2.5 by 300,000. What happens is you reduce the $1 million annual limit by 300,000. As a result, Y Corp could only expense 700,000 under Section 179. Z Corp places in service $1 million of 179 property in 2019. Z is eligible for 179 expensing for everything placed in service. Let's do this over. So Z Corp places in service 4.1 million of 179 property in 2018. So the problem we're going to see is that Z's qualifying property causes a phase out. 4.1 million is in excess of 2.5 million by 1.6. As a result, all of it is phased out. Z Corp is not eligible for any 179 immediate expensing in 2018. If they place in service $1 million in 179 in 2019, Z is eligible for 179 immediate expensing only for the property placed in service in 2019 using whatever limits exist in 2019. So it's not as if they get to carry forward that amount. They were not eligible for it to begin with. It was phased out. Okay, so now we made it past 2 of our 179 hurdles. One more to go. This is the income limitation. So Section 179 deductions cannot cause a tax loss. So Betty has 179 eligible expensing amount of $500,000. The problem is her taxable income from her business before considering any 179 is only $230,000. As a result, her Section 179 is limited to only $230,000 because any more would create a loss. In this case, when your 179 is limited by your income, you can actually carry that amount forward. So she'd be able to carry $270,000 forward to next year. Okay, these are a bunch of iterations that I've left in your slides for practice. My suggestion would be you try each one of these on your own. Here's all the answers. 2 iterations, 3 iterations, and a few final thoughts on 179. So 1 is applied each year to assets placed in service that year only. It is elective. We talked about that. You could apply $1 or up to $1 million. Typically, you would want to apply it to your longest lived assets because you're shortening the average depreciation by a greater amount by doing so. You do not have to elect the eligible amount. Even if you are eligible for it, you can elect nothing. The limit is taxable income after all deductions except Section 179, right? Because anything in excess of that amount would create a loss. So your book makes a number of simplifying assumptions in the homework and examples, but I don't think I'm even going to make you, I'll probably make you do one homework problem on this topic. So the carryover provision is helpful, right? So if it's limited by your income, you can carry it over. But think about how long can a small business maintain purchases of tangible personal property without generating any significant income? And I think the answer is not very long. Okay, so our second rule is bonus depreciation. So 2017 was a different world. So you can see that under the 2017 rules, we had 50% bonus in 2017, then it was going to go to 40, 30, 0. It applied to qualifying property, tangible property with a life less than 20 years, computer software, some qualified leaseholds, had to be new, business or production of income activities were both okay for bonus depreciation. Then the world changed. Now, starting 9/27/2017, you may deduct all of the cost. So this is just a fantastic accelerated depreciation provision that allows you to write off the cost of what otherwise you would have had to capitalize, really all the way up through the end of 2022. And I can tell you, it's supposed to go down to 80% in 2023. Yeah, we'll see when 2023 rolls around if that happens or not. So you can deduct the applicable percentage in the year placed in service. Qualifying property is tangible property with a life less than 20 years, computer software. It was meant to include qualified improvement property, but Congress wrote the code wrong, so it currently does not. You can take bonus on new and used property, and you can still apply it to both a trade or business or production of income activities. So this really is just a huge tax provision that's just wonderful for businesses to accelerate the cost of deductions for what otherwise they would have had to capitalize and depreciate. So Gina places in service a $400,000 machine in 2018. Assume 7-year life, half-year convention. She does not make a 179 election. Why would she? She can just deduct all of it anyway. All right, so that clears us for Module 9. Hopefully not too long, but I appreciate you guys watching. I'll see you in class.
Enough is enough! I have had it with these
unreimbursed employee business expense deduction.
Everybody strap